Hi, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today we're going to be talking about sequence of returns risk and how it affects your portfolio and what you can do about it. Okay, so disclaimer, I sell annuities. I help people with lifetime income guarantees. People reach out to me because they're looking for the highest payout, and often their advisor is showing them one or two options, and they reach out to me because I've got thousands of options, and I show everything that's available on the market. And it does not matter what the commissions are. I show everything anyways. So if you want to buy an annuity, or if you want to research, go to my website, johnstevenson.com, and you can research right there. And if you want to reach out, you're certainly welcome to. So, but this video, I want to talk about sequence of returns risk, and I want to visually show you how it can affect your portfolio. I know you're probably already thinking about this, but it is something that really, really hurts. Retirement accounts. And when you're trying to time your retirement according to the market, it can be very difficult. That's why a lot of times people will get annuity contracts even 5 years before they start income, because they want to make sure they can not have that risk, that the sequence of returns risk. And so really buying an annuity, it actually eliminates that. And I'll show that to you as well. But let's just look at the numbers and let's explore this together. Okay, so there's a few different things to think about. So when you're looking at sequence of returns risk, obviously, you want to take out a certain amount of income. You want to make sure that you have a certain amount of growth, and you want to make sure that the market does not perform badly and has the perfect timing for you. And of course, it never times it just right. So, but for this instance, I'm just going to share that this person they got $500,000, and let's say their life expectancy is 94 years old. Okay. And so I'm basing their annual income goal. They want to get, they're like, all right, I want to take a safe 4% withdrawal rate. Okay. So it's not very much. We need more income than that, but that's what we're going to do. So we don't want to run out of money. And I don't think this is the best approach. I'll just tell you right now, there are better approaches. Annuities will pay you double this, and it's guaranteed for life. But if you look at this and say, all right, well, 4%, well, 1% is 5,000. So, well, what are we looking at? Like $20,000? So $20,000 of income. That's what I'm going to get. Okay. Expect inflation. Let's just say 2%. Okay. Now, if we look at that, then we will see, and again, this is showing the worst 34 years, right? So it's probably not going to happen just like this, but there are years where we will have a nice correction. So if you look at this, here's what happens to an account value starting at $500,000. Well, if you have a couple of really bad years, not saying that we would, but if we did, then it's going to reduce that account value pretty hard. It's not going to be great. I mean, you can see here, it can reduce it. I mean, if we really have a bad recession for a few years, it's going to wipe out 2/3 of your account value. Okay. And then you've got some really good years. Look at that return, 53%. That's really good, but it only brings that smaller account value up to 194. And then let's say at the end of 5 years, you want to retire. Okay. We're doing this at 2 years. So at the end of 2 years, you're taking $20,000 out. And again, we're just taking out, you can see that we want to go up with inflation as well. So we're taking a little bit more out at a time. The problem with that is when you have the sequence wrong, the sequence of returns risk, then your account balance eventually depletes. And by the time you are 77, 78 years old, you're still alive. You're going to live to 94, remember? The money is gone. Okay. That obviously is a problem. You've been taking income to that point, but now it's gone. Okay. Now let's just go in here and say, well, let's just say last 34 years. Last 34 years. Well, we've had a pretty good decade. So you can see some good years on here. Okay. That looks pretty good. You look at that and say, all right, well, I'm good. I don't need an annuity, right? Everything's perfect. So in that case, I'm going to take $80,000. Okay. Take $80,000 out a year because that's really what I need. I want $80,000. Well, $80,000, my money's gone by the time I'm 80 years old. All right. Well, that's not great. So let's just say I want half that. That's good. That's 40,000. That's not bad either. So 40,000, not bad. And it kind of sustains it. So it's not too bad. And you can see I can take out more income over time, right? So it just depends on how things go, right? And so it's just, here's the thing is you don't know what's going to happen, but you have to realize that it's probably not going to be exactly like the last 34 years. It's probably not going to be exactly like the worst 34 years, okay? But you do need to realize that it will happen. You will have years where it's up and you'll have years where it's down, and it's down badly, okay? So that's what you have to think about is how's that going to work? So then you look at this and say, okay, well, I really don't want to deal with the sequence of returns risk. Okay. I know that there's risk. And obviously if I put my money in the stock market right now, or I leave it in the stock market and we have a downturn of 20%, let's say I got 500 grand, it goes down 20%, I'm down to 420. But then great. It goes back up 30%. The problem is you need more growth to make up what you just lost. Right? So if you got a rebound of 30% after that stock market loss of 20, okay, you got $420,000, right, after your loss, okay? Multiply that by 0.30, okay, that's 126,000. So actually, I guess you did make it up. So, but I guess what I'm trying to share with you is if you're worried about the market affecting your account, even for like 1 or 2 years during the next 5 years, and you want to take income out at 5 years, you might have a perfect first few years, or you might have a really terrible first few years, or you might have a really good couple years and have a terrible middle year. It does affect everything. And so a lot of times what people do is instead of dealing with this, and you could change all this, you could say expected inflation could be 3%. Okay. If you do that, then that changes these numbers. So you can see that this doesn't grow as much, right? So I can go up here and say, well, what if I want, what if I want to start income in 1 year? Okay, look at that. Say that changes those numbers too. Now let's say I wanted to inflate this right from the beginning. Okay, because we are having current inflation. That changes the numbers as well. And again, we don't know what the market's going to do. I mean, I wish I could do like a middle of the ground here, but obviously worst case scenario, you're going to lose your money really fast. And that can happen. So it's hard to know. And that's why people will buy contractual guarantees. So having said that, I'm going to scroll over to that. So we're going to go over to the income rider. And I'm going to say the same 2 years, same $500,000. You look at that. There you go. There's your guaranteed income. $43,000. Never, ever will reduce. You can see right here, it's probably more than you normally would be comfortable taking out of your $500,000, especially if the $500,000 depletes to $450, during the 2 years. Maybe it goes up and then it goes down more, right? Now all of a sudden you got $450 and you're like, I'm not comfortable taking an almost 10% withdrawal rate. Okay, so you might take, I'm more comfortable taking 4% because I want to have enough in here to rebound, right, to cover me. So that's the problem you deal with. But with an annuity contract, they're like, no, we'll give you $43,000. Okay, we're going to take a benefit base of 574, multiply it by 7.54, and we're going to give you guaranteed income for the rest of your life. Now, the account balance is not going to stay up. You can see even with a little bit of growth that it'll be gone by the time you're 74. This is designed to run out. But for the income, that's designed to be a pension forever. Okay, now you got a lifetime pension. You don't have to worry about it. You don't have to stress about the sequence of returns risk. You don't have to sit there and watch your account all the time. That's why I'm talking about this in this video, because people are always trying to stress out. They're like, I want guaranteed income, but I want more growth, but it's hard to have both. And so just take the portion of your portfolio that you want guarantees from. That's it. Just take that amount and you can buy an annuity contract that will provide that lifetime income that is guaranteed. You don't have to worry about sequence of returns risk. You can leave the rest of the money in your stock market. And if the stock market has a really bad 2 or 3 years, you're okay because you're not relying on that portion for income. You've already got your income set up over here. That's why annuity contracts can be such a valuable tool in your retirement. So anyways, I just wanted to kind of illustrate that because it is, I look at the $43,000. Look at that, $43,000. Let's just do some math here. Say 43,000 divided by 500. You get a 0.86%. Like the withdrawal rate is 8.6% of the 500,000. Okay. No one normally would do that, right? Even if you are at retirement and you're thinking, oh, I'd like to have 43,000. I've got 500,000. Let's say you didn't lose any money during that. Let's say you gained a little bit, right? Let's say it's like 550. Are you still going to feel comfortable taking 43,000 out of a 550 balance? Most of us would say no. We're like, no, I want to make sure this grows. So especially when I have those bad years when it takes a dump, I still have enough of a base to keep earning enough so I can keep on taking the income that I need to take. So that's what you have to deal with sequence of returns risk, is you have to manage that account. You have to manage that anxiety, that emotion. And especially if you're married and you pass away, your spouse has to manage that. And so annuity contracts are not the best for growth. I'll be the first to say that. They're not the best for growth. But you don't buy them for that. You're buying them for contractual guarantees. You're buying them for that portion of your portfolio that you need exposed to guaranteed income. Okay. And then the rest of it, you can expose it to risk if you so choose. And I actually like risk. I like to have the growth, but I understand that there are years where you have really, really bad years, and they do happen, and they probably will happen in the future. And it's just how it works in the stock market. So in order to stay away from that, still get the growth you want, because we all want growth, but we've all lived through the Great Recession, okay, the dot-com bust, the savings and loan crisis, right? You've got that. And you even had in 2020 with that big crash. Like, it happens. It's going to happen. It's normal. But there's no sense in being stressed out about it if you don't have to. And so buying an annuity contract can allow you to have a lot of guaranteed income from a portion of your portfolio, not all of it, but a portion of it, and allow you to sleep at night. Okay, you've got that income. Maybe you got Social Security as well. Maybe you're like a few of my clients who think Social Security is not going to be around, and so you feel like you need to have more of that annuity money coming in. That's why these work so well. That's why Babe Ruth bought them, and when he lost everything in 1929, he was still able to have the income continue from his annuity contracts, because that's what he bought. He bought peace of mind, and it's just hard to put a price on that. So anyways, hope this has been valuable. Hopefully you've been able to just get some information as you kind of search and do your research and kind of decide, all right, what do I want to do? How do I want to structure my retirement? If you're looking to purchase an annuity, I'd love to help you. There is a link below this video, and you're certainly welcome to book a call with me if you'd like my help. Otherwise, go to my website. You can research the annuities there, and you can book a call with me there as well. It'll be a Zoom meeting, and I'll share my screen, and we'll look at all the options available. And then, of course, you can decide at that point what you want to do. So I don't like to push people or try to hard sell people into something, but if you are looking, I'd love to help you. So, but again, it's important for you, if you're going through the research and you're looking for the best annuity contract for yourself, it's important to be able to find all of the options, right? Kind of like when you're shopping around for a mortgage loan. You want to be able to make sure you get the best possible rate. Okay, it's nice to be able to have that, and so for me, that's important to me. So I work with over 70 carriers and thousands of different variations and annuity contracts, and it's really, really important for me so that you can see everything that is available, and then at that point, reach out. So anyways, hope this is helpful. If you like the video, like, subscribe, share, comment below, and we'll see you next time.